Are the markets about to face a storm with surging oil prices and jobless claims?
We dive deep into insights from Bjarne Schieldrop about rising oil prices and Snider on alarming jobless claims.
All this plus the ominous predictions from Jim Rogers about the impending debt crisis.
Our AI-powered summaries deliver key insights quickly, ensuring you stay informed and prepared.
Join us as we unveil crucial financial insights that could transform your investment strategy.
And don't miss the next video featuring Snider explaining why jobless claims may skyrocket.
Anchors away, let's dive into a pressing issue. Jobless claims are about to skyrocket. What's causing this wave?
Indeed, Snider points to a significant spike in jobless claims, the highest in over a year, with factors beyond just weather impacting employment.
That's a storm we can't ignore. But what's the main message here? So what's the crux of Snider's insights?
The thesis highlights how initial claims jumped significantly, partly due to natural disasters like Hurricane Helen, but other economic indicators suggest deeper issues with unemployment and layoffs impacting the labor market.
Let's unpack what Jeff covered on jobless claims.
We see a troubling rise in claims. In Michigan, layoffs at Stellantis raised alarms, while California's increases give us pause as they're unrelated to the hurricane.
And the repercussions.
With spending power reduced, people on unemployment for longer will slow economic activity, an alarming trend indeed.
Shifting gears, what did Snider say about consumer prices?
Despite widespread concern about inflation, Snider suggests there's a struggle. Prices are sticky, not adjusting to the disinflation trend everyone is missing.
What about examining longer trends affecting employment?
Jobless claims can express broader market concerns. As individuals spend less and stay unemployed longer, the ramifications may heighten social and economic tensions.
And what signals are we picking up for the future?
Snider warns these jobless claim surges could signal an impending recession if the trend continues. Recovery in this case looks bleak.
What does the future hold based on Snider's insights?
The prediction is grim. Rising claims hint at a declining job market and potential layoffs affecting multiple sectors.
And inflation insights.
As job losses affect spending ability, consumer prices could gradually adjust downwards, but not without significant adjustment pressure.
To wrap it up, what's the big takeaway?
Snider emphasizes that to navigate these rising challenges, robust laws and strategic interventions in labor markets are needed. Ignoring increasing jobless claims won't suffice.
But hold on to your hats. Up next, we'll dive into why oil could 5x to $350, crater world economy, featuring insights from Bjarne Schieldrop.
Trust me, you don't want to miss what's coming next.
Ahoy there! As we dive into the depths of the oil market, let's navigate the waters of rising prices.
Bjarne Schieldrop lays it all out, claiming oil prices could surge to $350 if we face significant supply disruptions.
That's a storm brewing. What's behind Bjarne's bold predictions? What's the main thesis of this discussion? What's at stake for the global economy?
Bjarne points out that oil prices could explode under supply disruptions. Historical patterns suggest prices could multiply dramatically, reflecting the fragile balance of supply from key routes like the Strait of Hormuz.
Let's sail through some key points, starting with historic price surges.
Exactly. Bjarne highlights how commodities notoriously skyrocket when supply is threatened, like nickel after the Ukraine invasion.
Next up, what happens in case of a supply shock?
If the strait gets blocked, we're talking about losing 18 million barrels per day. That's a hefty chunk of the global market gone.
What are the broader repercussions?
A spike would be a double-edged sword. Bjarne warns high prices could trigger global inflation, sending economies reeling.
Forecast time. What's on the horizon?
Bjarne predicts increased military activity in the Persian Gulf as nations rush to secure oil routes. Tensions could escalate swiftly if nations retaliate.
What about OPEC's role?
Bjarne indicates that OPEC is likely to play a key role in adjusting production to maintain some semblance of price stability. They have more power in this scenario than folks might think.
To wrap it all up, what are the key takeaways from Bjarne's insights?
In essence, the oil market faces significant risks ahead. Understanding these dynamics is crucial for both consumers and investors.
But wait, up next, we'll dive into insights from Jim Rogers about looming crises in Jim Rogers. We're on a collision course with crisis.
That's a voyage you won't want to miss.
Ahoy there! Let's dive into the stormy seas of global finance. Jim Rogers is sounding alarms about a looming crisis.
Indeed, Rogers warns that the current accumulation of debt could lead to substantial economic repercussions, potentially even currency crisis.
That's a shipwreck waiting to happen. What's got him so concerned? So what's the core message here?
Essentially, Rogers asserts that an unsustainable debt trajectory could lead directly to currency controls and withdrawal from global markets, reflecting historical patterns.
Let's break down the risks up next. What's happening in the US stock market?
It's been over 15 years without a major setback, a record length, which might signal that trouble is brewing.
Now, how about all this global monetary easing?
While it sounds good, Rogers hints we might just be rallying before a big storm.
And inflation, what's the forecast?
It's heating up. With demand rising and supply chains still unstable, we're likely facing further inflationary pressures.
What does Rogers see on the crystal ball?
He foresees a significant financial crisis approaching, largely due to unchecked debt levels.
And what about currency? Any grim forecasts?
He warns of potential currency controls becoming necessary as governments will need to manage the chaos.
To summarize, what can investors take away?
Rogers believes caution is critical. Investors should diversify and remain aware of rising debts potentially leading to crises.
Final thoughts before we embark on the next section.
Indeed, investors must remain vigilant and proactive about their strategies as signs of strain grow.
And hold tight. Up next, we're bringing in FX Evolution to break down earnings predictions and current market movements.
You won't want to miss their insights as we explore market landscapes in flux.
All right, hoist the sails for our next topic. It looks like Bitcoin is ready to shine with significant movement.
Absolutely. The recent liquidations in Bitcoin have been quite the spectacle, and it's crucial to uncover what's behind this trend.
That's right, especially with October shaping up to be a pivotal month. What exactly are we keeping an eye on? So, what's the central thesis here as we dive into Bitcoin?
The core thesis is about the potential bullish momentum we might see if Bitcoin can close above 66,000. This could lead to a series of long positions.
Interesting. So what would that mean for traders looking to capitalize on this surge? Let's break down the key points about Bitcoin's price action. What can we glean from recent events?
The massive liquidation of over-leveraged positions has shocked the market, creating ripple effects. If we close above 66,000, expect bullish momentum.
So a crucial resistance level to watch then. What's the community sentiment around this? Now, how about the earnings season? It seems to be a crucial time for the markets.
Right. Historically, earnings seasons bring about average gains of 2% over 4 weeks, so traders should strategize accordingly.
Truly fascinating. How do sectors play into this dynamic? Shifting to market trends now, what are the overarching predictions?
We're observing sustained bullish sentiment. Identifying breakout levels across sectors is key to navigating this effectively.
Sounds like traders need to be vigilant and ready. What key sectors should they focus on? Let's peek into the crystal ball. What predictions are emerging for Bitcoin?
If Bitcoin holds that 66,000 close, we could witness a significant run-up, drawing in more traders.
Sounds like a necessary bell to watch. What about the upcoming earnings reports? What should traders anticipate?
They'll play a huge role in influencing market shifts. Financials are likely to experience heightened activity.
That's definitely a space to keep an eye on. To wrap things up, what are the main takeaways regarding Bitcoin and the upcoming market?
Bitcoin's future can significantly influence overall market trends as we dive deeper into earnings season. It's a pivotal moment.
Absolutely. And stay tuned for our next video, where we'll delve into insights from Matt on the Nasdaq is still lagging the S&P 500. You won't want to miss it. Ahoy, trading enthusiasts. Our next insightful summary dives into the fortunes of the Nasdaq compared to the S&P 500.
Indeed, Matt opened with the recent earnings season, highlighting JP Morgan's remarkable performance. But what about the Nasdaq?
What's the essence of this video?
Matt asserts that while the Nasdaq is trailing, it's not all doom and gloom. With strong undercurrents in semiconductors, there's opportunity for a rebound.
Kicking things off is JP Morgan's stellar earnings. How does that impact the indices?
Their performance has pushed the S&P to new heights, creating excitement in the market.
What's the latest on the S&P's performance?
With a solid close at an all-time high, the trend is unapologetically bullish for now.
And how is the Nasdaq keeping pace?
While it lags, the rising semiconductor sector could ignite a much-needed catch-up.
So, what's the technical outlook with Fibonacci?
Fibonacci levels highlight support at 486 and resistance at 503.25.
What do the predictions say about market reactions?
The consensus leans towards continued bullishness, with pullbacks presenting buying opportunities.
And those predictions, what are they hinting at for the future?
They're pointing towards a bullish trajectory, particularly if semiconductor trends sustain.
Are any risks on the horizon?
Absolutely. Earnings volatility could stir the pot and lead to a roller coaster in stock prices.
To sum it all up, what's the takeaway?
While the Nasdaq has its challenges, the bullish signals suggest a brighter horizon ahead.
But wait, there's more. Next up, we'll dive into insights from Joseph Wang.
Buckle up. You won't want to miss what he has in store.
All aboard as we dive into the thrilling highs of the financial markets. Joseph Wang highlights the S&P 500 soaring to all-time highs this past week.
But it's not all smooth sailing. We've got 3 waves to navigate through today: the surging 10-year yield, rising auto loan delinquencies, and the discount window dynamics.
Anchors away. Let's hoist our sails and tackle that 10-year yield first. What's at the heart of these soaring market indexes?
Joseph emphasizes that while market sentiment is euphoric, the rising 10-year yield hints at deeper financial complexities that could signal potential shifts in consumer behavior and inflation concerns.
Setting sail for our first key point, the rising 10-year yield. What's driving this surge?
Well, it closed at 4.1%. This surge reflects market confidence as fears of recession diminish, thereby pricing in fewer rate cuts from the Fed.
Next stop, auto loan delinquencies. How are these impacting consumer sentiment?
Despite an uptick in delinquencies, Fed researchers found it's mainly due to higher loan balances taken during a period of inflated car prices rather than an immediate consumer collapse.
Sailing into our final point, what's the latest on the Fed's discount window?
Vice Chair Jefferson discussed the need to revamp its usage, aiming to mitigate stigma and ensure it's a valuable tool for financial stability, especially during crises.
And what's the crystal ball saying about interest rates?
If economic growth stabilizes, we might see lower expected interest rates. Future spending will be closely tied to inflation trends and consumer confidence.
So what's the bottom line from Joseph's insights?
There's a complex landscape ahead. While the markets soar, underlying economic indicators like the rise of delinquencies and yield trends paint a nuanced picture that needs to be monitored closely.
If these financial waters have piqued your interest, don't hesitate to hit that like button and subscribe.
Your support ensures we continue to bring you the insights that keep your financial compass steady. We've got more treasure waiting for you.
What a compelling discussion we had today about the financial markets. Bjarne Schieldrop's prediction of oil prices soaring to $350 is alarming, right?
Absolutely. But we can't overlook Jeff Snider's point about the rising jobless claims signaling deeper economic trouble ahead.
And then we have Jim Rogers, who warns about the mounting debt levels that could lead to a currency crisis. It's an essential reminder that the risks are multifaceted.
Indeed, the consensus is that we're in for some turbulent times ahead, but each expert brings such a valuable perspective.
So to our viewers, if you found today's insights useful, do us a favor and like this video and subscribe to our channel for more financial updates.
And don't forget to catch our other content to stay in the loop on the latest market trends and expert analyses.
Thanks for joining us today. Until next time, stay informed and keep those investments sharp.